Welcome to InvestMinder. Today we are revealing Warren Buffett's top 6 dividend stocks that generate a massive $4.79 billion in passive income for the legendary investor every year. That's right, $4.79 billion in annual dividend checks from just 6 stocks. These aren't tiny upstart companies either. They are blue-chip giants like Apple, Bank of America, Chevron, Coca Cola, Kraft Heinz, and Occidental Petroleum. Before diving in, please take a moment to subscribe to InvestMinder to keep up with all of our latest investing videos helping you build wealth. Now for our disclaimer, we are not professional financial advisors. This video is purely for entertainment and educational purposes. Please consult a licensed advisor for actual investment recommendations tailored to your personal financial situation. With that out of the way, let's take a look at how Buffett uses these dividend payers to generate such an astronomical passive income stream. Even though Berkshire Hathaway itself doesn't pay a dividend, through large ownership stakes in these 6 stocks, Buffett takes home almost $5 billion per year in dividends. We'll analyze each holding individually, looking at metrics like dividend yield, total dividend income, and percentage of Berkshire's full portfolio. How does the Oracle structure his portfolio to optimize recurring dividend checks? Let's find out. First up is Apple, which makes up a staggering 45% of Buffett's entire portfolio. He owns over 905 million shares worth over $120 billion as of February 2024. Now, those numbers are just massive and highlight how important of a long-term holding Apple is to Berkshire Hathaway's asset base. In terms of dividends, Apple pays a modest yield of just 0.52%. But when you consider the sheer size of Berkshire's position, that tiny yield turns into almost $870 million per year in cold, hard dividend cash. Apple really checks all the boxes that Buffett looks for in a company: a wide economic moat, legendary brand, environmentally conscious operations, and a rock-solid balance sheet with over $170 billion in cash. So while the yield is lower than the S&P 500 average, Buffett is happy getting paid close to $1 billion annually, while Apple's stock continues to rise over the ultra-long-term time horizon that Berkshire invests across. This is a textbook example of Buffett's strategy: buy great companies at fair prices and allow compounding to work its magic. Apple has treated him exceptionally well, with his stake now worth over 50 times his original investment, even accounting for all the shares he has sold. And being the largest public U.S. company by market cap and revenue, Apple certainly isn't going anywhere. iPhones and MacBooks will still be sought after technology products for years to come. This cash cow will continue paying Buffett his juicy dividend checks for the foreseeable future. While he has trimmed his Apple position lately, it still represents the crown jewel in Berkshire's portfolio of public stocks. Next up is Bank of America, which pays a strong dividend yield of 2.81%. Berkshire Hathaway owns over 1 billion shares worth about $33 billion, making Buffett's second largest public holding behind only Apple. Beyond the steady dividend, Buffett has praised Bank of America's management, led by CEO Brian Moynihan. As one of America's big 4 consumer banks, along with JP Chase, Wells Fargo, and Citigroup, Bank of America benefits from economies of scale in an industry resistant to disruption. Its broad national footprint, combined with tens of millions of loyal customers and clients, has given BOF a dominant market share across nearly all financial products and services. The banking sector also generally performs well in rising rate environments like the current one. As the Fed boosts interest rates to fight inflation, banks reap bigger profits lending money. Higher rates allow them to charge more on loans and credit cards without necessarily paying significantly higher income to depositors. So shareholders like Buffett enjoy fatter dividend checks when rates are on the rise. With nearly $3 trillion in assets, there is still plenty of room for Bank of America to prudently grow lending across mortgages, auto loans, and business lines of credit. This gives the bank a promising growth runway for the next several years, as rates could stay at elevated levels. That should drive earnings, allowing Buffett to simultaneously return lots of capital to shareholders through dividends and buybacks. From Berkshire's Buffett investment generating about $900 million in dividends, we move to the energy sector with oil and gas titan Chevron. Now it may seem surprising for Buffett to own an energy company given his typical aversion to volatile commodities, but Chevron fits his mold of a dominant, extremely well-run business. Like Buffett, Buffett has highlighted Chevron's management, specifically its CEO Mike Wirth and Vice Chairman Jay Johnson. Essentially, Buffett views Chevron as less of a pure play oil producer sensitive to crude prices and more akin to a high-quality consumer staples company that just happens to drill oil instead of making cereal or soap. But by paying a generous dividend with consistent payout growth, Chevron resembles the safety and defensiveness of consumer staples names that are longtime Berkshire holdings. Sticking with the theme of dominant blue-chip companies, the Coca-Cola company checks all of Buffett's boxes. It possesses unparalleled brand recognition and pricing power, throwing off large sums of very consistent cash flow. Buffett has called Coca-Cola one of his best investments of all time since he began building his massive position back in the late 1980s. Berkshire owns a staggering 400 million shares worth over $24 billion, making it one of his largest holdings behind only Apple and Bank of America. Coca-Cola pays out a very reliable dividend with a 3.06% yield, higher than the S&P 500 average. This results in Berkshire earning over $700 million per year in Coke dividend checks. Now, Coke hasn't been a huge growth story in recent years compared to tech giants like Apple or Google. But to Buffett, Coca-Cola represents the textbook case of a wonderful business bought at a fair price. The company possesses an unequivocally strong brand and global distribution network, while facing fairly inelastic demand for its products despite pricing ups and downs over time. In good economies, people enjoy indulging in Coke products, while during tougher times, people look to cheaper sodas like Coke for simple, affordable pleasures. This was evidenced throughout the pandemic as Coca-Cola maintained steady revenues comparable to pre-COVID levels. And we can't forget Coke's ownership of fast-growing Monster Energy, which continues gaining market share against full-sugar soda brands. Buffett admires leaders like Coke CEO James Quincy, who focus more on dominating the global beverage industry for decades to come, rather than putting up huge growth numbers quarter to quarter. This long view fits perfectly with Buffett's patient buy-and-hold approach to investing in wonderful companies like Coca-Cola. He trusts Quincy to smartly reinvest Coca-Cola's prodigious cash flows into new products as consumer preferences evolve towards healthier options. But the mission remains the same: refresh the world and enhance shareholder value through consistent but modest growth along with dividends. Next up is Kraft Heinz, the giant food manufacturer formed by the 2015 merger of Kraft Foods and H.J. Heinz Company. Berkshire owns over 325 million shares worth close to $13 billion at a 5% portfolio weighting. While not as much of a darling holding like Apple or Coca-Cola for Buffett, he still relies on Kraft Heinz to deliver steady dividend income exceeding $500 million annually. Although the merger succeeded in cutting costs through synergies, some pundits think that Kraft Heinz neglected too much product innovation and brand building. But renewed focus in these areas plus strategic marketing should help strengthen pricing power and regain market share after losing ground to private label offerings. And make no mistake, Kraft Heinz owns some incredible food brands. From Heinz ketchup to Kraft macaroni and cheese, Oscar Mayer cold cuts to Maxwell House coffee, these products benefit from unparalleled distribution scale and immediately recognizable packaging on consumer supermarket shelves. While adjustments are still needed following the merger, Kraft Heinz generates immense cash flow from its portfolio of leading brands that maintain dominant category market share. The vitamin and nutrient fortification of products also matches up well with consumers' growing focus on nutrition and wellness. Even through challenges over the past several years, Kraft Heinz has maintained solid operating margins and continues working down debt. Most importantly for Berkshire's purposes, Kraft Heinz has kept up healthy dividend payments yielding nearly 5%. And with brands almost guaranteed to remain grocery staples despite economic fluctuations, Buffett feels comfortable relying on Kraft Heinz for over $500 million in dividend checks each year. That contribution is pretty safe for the foreseeable future. While not as flashy and fast-growing compared to the Apples and Coca-Colas, Kraft Heinz fills an important role for Buffett's portfolio. The sixth and largest dividend payer for Buffett in terms of yield and income is Occidental Petroleum, Oxy. Berkshire owns $17 billion worth of Oxy common shares, paying a modest but meaningful 1.45% dividend. But the real income engine lies in $10 billion worth of high-yielding Occidental preferred stock. Get this, the preferred shares throw off a whopping 8% annual dividend. That translates into a mind-boggling $800 million per year in recurring income just from the preferreds. tack on another $220 million from the common stock, and Occidental contributes over $1 billion annually to Berkshire's coffers. Now, Buffett doesn't invest in volatile oil stocks on a whim, but he views Occidental as less of a pure-play petroleum name and more akin to an integrated industrial conglomerate. Beyond upstream exploration and drilling, Occidental possesses valuable downstream assets in midstream transportation/storage and the chemicals business. This wider moat makes Occidental's cash flows more dependable and buffered from oil price swings. And the bold preferred share investment exhibits classic Buffett. Help finance a strategic acquisition for Occidental in exchange for more favorable fixed income terms that common shareholders wouldn't receive. The hefty dividends may seem risky, but Buffett did his homework on Occidental's management, financials, and integrated business model. While certainly cyclical, Occidental's breadth across the oil value chain gives Buffett inflation protection and substantial cash income during times of energy scarcity like now. For the overall video conclusion, hopefully this analysis has highlighted promising dividend opportunities and inspired you to start building your own durable income stream. Please subscribe for more investing insight and dividend stock research. Thanks again for watching, and good luck with your dividend empire aspirations. Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.